Good evening, ladies and gentlemen. Welcome back to probably one of the greatest weeks we've had in the market in such a long time. I'm going to break down what is perhaps causing this massive rally. We're going to take a look at a bunch of stocks. Ask, is this just a short-term blimp and a long-term decline? Should we be buying up? Because I'm buying up. I invested $10,000 this week. We're going to talk about what I put that $10,000 in and why I'm probably going to be investing pretty aggressively into the end of the year. We've got a lot to talk about this evening, and thanks for everybody joining. We the cult, Kyle the leader. You're all leading your own portfolios. I'm just here to show you my own insanity as I try and wrap my head around this nutter market, because my God, this week was unlike something we haven't seen in a long time. I think we've been getting too used to the negativity in the market, and people really gave up until this rally hit, and people are like rattled. Look at this jump. This is the S&P 500, man. Look at this 5.85% jump that happened over just like a few days. Like, this was just crazy seeing such a wicked rally coming into the end of the week here. And I think this kind of revitalized something I was talking about last week on the stream, which was so many people are sitting in cash that they were kind of getting psyched into this idea that the market's just going to perpetually go down. And then we're going to get these moments, like I mentioned, where the market can just pop 10% for no God-given reason. I mean, we got some earnings we're going to talk about. We talked about a lot of them this week. I want to re-follow up on things like Enbridge, some of the Canadian stocks, and what we can kind of expect moving forward. And we've already got a lot of tech earnings baked into this market now, and we kind of know what's going on, right? And it hasn't been all that great. I mean, earnings aren't explosive by any metric. I mean, some stocks did pretty well. Let's be real. The stock performance, I think, did better than perhaps the actual, underlying fundamentals of the stock. But let's get into this a little bit. First and foremost, I want to show you that it's so funny that you can see how people are spending their money on the broad scale. And I don't know if this is fund managers. I was listening to some big billionaire guy talk about how a lot of this has to do with technical trading when it comes down to basically these big money market funds that are closing off end of the month deals. They're transferring funds around. So you're seeing money come out of money markets back into the stock market, people taking losses, locking some of those in, and then rebuying and adjusting. I don't know, because a lot of companies have year ends that aren't actually, obviously, if you've started a corporation, your year end is debated on when the corporation started. It was a little bit too fuzzy for me to wrap my head around, but you can see the direct correlation of people spending money just looking at the US dollar. I mean, look at this wicked drop off. If you really want to see, because like I said, during these geopolitical events, during everything going on, everybody wants to be in the US dollar. That's where safety and security is. And when you flood into cash-based assets, your money is just sitting in that as an investment, right? You want US dollars, so the demand of the value of it goes up on a global level. But look at this. It almost directly correlates to the S&P 500, because if you take a look at the year to date on the S&P started rallying pretty much at the same time let me make sure I got this backwards. I'm not saying this correctly, am I? But basically, the S&P 500 from the summer started rallying pretty aggressively. Take a look at the dollar here. Right when it started selling off was coming into the end of summer, right? So we saw that big rally in the S&P 500 coming into the summer. And then as soon as it started selling off over the last few months, the US dollar coming out of August rallied aggressively, right? So as people sell off, their stocks, they're buying dollars and they're keeping dollars. And now that when the US market rallies aggressively 5.5%, all of a sudden the US dollar drops down in value because people are flooding out of that cash back into assets. Now, I wish you could actually take this knowledge and put it towards some useful investment thesis, but you can't. It's just general intriguing data points that trade off each other to look at, in my opinion. So it's nice to see how they play against each other. But taking a look at the broad market here on the TSX side, if you're Toronto investors like I am, look at this. The Canadian markets usually don't move like this. So when we get these kind of wild jumps where you're seeing like the banks up anywhere from 5 to 10%, these oil stocks, Shopify's up 30%. I mean, even the telecom giants like TELUS was up 10%, BCE up, oh my God, like crazy numbers, right? Like this is where FOMO begins. I mean, look at NVIDIA here, jumped 11%. Apple's up 5% on like probably the worst earnings. I wouldn't say they're the worst, but they're not like the most entertaining earnings. They were able to bring up their EPS, but revenues continue to decline. iPhone sales, MacBook sales, everything is just falling off a cliff for them outside of services. But yeah, I mean, this is just wild. I mean, Tesla, I'm telling you, I wanted to buy a Tesla under $200, and here we get the Tesla under $200. And it literally lasted for like a day. And then it went back up to 220. So I haven't bought Tesla, but I did buy some stuff. But we'll take a look here. So I want to talk about, first and foremost, before we get into the 10,000 I invested, I'm going to give you a broad view of my portfolio where it sits today. But a lot of people think this has to do with the Fed pausing rates. And I don't think this has anything to do with the Fed pausing rates. Here in Canada, we already figured out that they were going to pause. Canada always posts what they're going to do from the inflationary measures first. And the Bank of Canada said, hey, we're pausing. And then no surprise, the Fed said, hey, we're going to pause. I think it's unlikely we see another rate hike into the end of this year because of the amount of damage that's being caused already to the real estate market and basically millennials. I don't know if they're going to pressure interest rates that last quarter point they want to do. I think if inflation stays cooled off and we don't see a wicked like rally, they're going to just see what Christmas does. And I think it's going to come in lackluster at best. Inflation's not going to be crazy. So they're going to stop raising rates because I think it's just damaging the economy so aggressively. But a lot of you had opinions on this. And again, I don't think this is moving the market at all because they've continued to pause rates. But we've seen some comments here like inflation is here to stay. Didn't expect any rate cuts for at least 6 months. Second spike of inflation would mean the CAD dollar becomes more worthless and minimum wage jobs jump to 20 an hour. Minimum wage continues to go up. Purchased Canadian apartment properties a few days ago for $41. Quick 10% pop. Congratulations. I think it jumped like 12%, man, from the bottoms there. And already own Enbridge and T at lower prices. So tell us, good for you. Don't expect rate cuts. Someone replied at all. They are needed. Doing nothing on rates is good enough. So let's read one more comment, and I got a few opinions on this because a lot of you get really heated about this conversation, which I find super entertaining. When I listen to most big players say the end of low interest rates are here, same as the Fed, I would not fight them. It's difficult for us to understand what is going on because most of us were too young to remember a world with high interest rates, but we should position our portfolio accordingly. Dividend stocks are actually doing what they're supposed to do in high interest rate environments. Their yields need to be higher, hence stock valuations go lower just to match that because it's competing against the yield, obviously the yield of the government bonds. What I don't agree with most YouTubers is the fact that they just because you haven't seen stocks this cheap in your lifetime, it means it means they're cheap, right? It doesn't mean they're cheap. Probably I could respond. Oh, let me reread that. I could respond that stocks have been crazy high in the last 10 years and now they are just going back to the normal levels. We just have to adapt to this new way of looking at things. It is positive because we're going back to fundamental investing. So be very careful about rushing out and buying what seems to be cheap because unless we go back to easy money, stock valuations and at relative prices could take decades or at least many years to get back to those levels. And maybe we saw the peak for them. So I want to kind of iterate two things here when I talk. First and foremost, that inflation isn't dead based on that last comment. And then I want to talk about stock valuation specifically and why I kind of disagree with some of these statements. But first and foremost, I'm worried with inflation on two aspects, which always comes back down to government printing money. Inflation isn't caused by interest rates. It was it was a helping hand when the government started handing out, when they printed off like so much friggin' money. I mean, they printed off, what was it, like half the entire US debt within like that 1 year just because of the pandemic. That's what naturally causes inflation, right? And now they're trying to fix that problem from a great disaster, or what could have been an even worse disaster, which didn't end up being as bad as people thought it was going to be, which it still was bad, but I think they've over-exaggerated the pandemic, leading the Fed to do a lot of Band-Aid fixing. So basically inflation's done so long as they don't print a lot of money, and they're continuing to print money, and it's bothersome on both sides of the border because you have like the Infrastructure Act in the US, which is like over $1 trillion. That's going to last 8 years. You've got the CHIP Act that's going to last 10 years. It's another $250 billion. I don't know how much of that is directly inflationary, but it is handouts from the government that continue to I don't know if that's directly in relation to debt and putting more money in circulation, but you got to pay attention because when they spend more money, or they do what they did in Canada here and put carbon tax on everybody, which basically, if you don't know what carbon tax is, the government just doesn't like carbon emissions. So they're going to tax it and continue to put higher taxes on it to try and get people to innovate away from using carbon fuels. Meanwhile, they're doing it in the midst of one of the worst inflationary things we've ever experienced in since the 80s. So I don't know why they're continuing to put carbon tax when you raise the price of fuel and everything goes up with fuel. It just continues to put pressure on inflation. And now we know inflation is self-inflicted because it's also housing. If you raise money on housing costs from interest rates, it's going to raise inflation because landlords got to raise it on the tenant. Mortgage is going to cost more. Housing expense goes up. I mean, at this point, we can stop presuming that inflation is where it was. We're done with inflation, I think. I don't think there's going to be crazy money printing. I think we're good. So from the other vector of this, I want to talk about stock earnings and valuations and where the bubble actually existed and why now I think is a true buying opportunity, because especially with dividend stocks, I get that dividend stocks need to match inflation. But the fact of the matter is what we're experiencing right now is going to be temporary, in my opinion. I don't think what we're going through right now is normal. I don't think it's going to be a new normal. I think it's just something that's going to last until the Band-Aid, has been put over and finally healed the wound so we can take the Band-Aid off. So when you take a look at something like Alphabet, let's talk about two major companies here. Alphabet, trading for a PE of 26, I don't think is that expensive here. I think some of these technology companies that have huge innovations into the future that own these crazy moated businesses, and considering Alphabet purely trades off advertising dollars, has a direct correlation to a recessionary event because people just aren't spending advertising dollars like they would have if it wasn't for a recession and higher interest rates. So we can see the decline in the revenue. However, the revenue is starting to go back up. It looks like we're coming out of the worst of what this experience was, and people are spending more money on marketing because they're starting to see double-digit revenue growth again. Now, during the pandemic, when people were handing out money, we can see a lot of that money went into these businesses because people took all that free money and they're like, hey, we want to grow our business. We're going to take loans out, cheap loans from the government, all this stuff. Let's put it into some Google ads. And we saw massive, massive revenue spikes. So in my opinion, you can't justify just the value of a company based off revenue, but we're going to talk about Amazon because Amazon's was basically a revenue valued company. But I mean, EPS does come into play. There's a lot of ways you can value this, but I think that revenue is going to come beyond this. And the stock market wasn't overvalued, I think, when it was trading in the 20 times PE levels, when for the last decade, the market was growing at a 20 to 30% clip. This isn't the dot-com era where mega cap companies were growing at absurd levels in valuations when the revenue wasn't there to support it. Because it's not like Google's ever been trading at like the 40 or 50 or 100 PE level like NVIDIA is right now. I mean, Google arguably has always been trading within a decent range based off its revenue, right? And now revenues come down, but the revenue is starting to go back up. But if it recovers back up to even 10 to 20% range and stays here, I don't think it's unjust to give Google, a 20 to 30 times multiple. I don't think that's unfair, especially with all the innovation that's potentially coming down the road. So I can't say Google's at some kind of crazy valuation in this market environment. If anything, I still think it's relatively reasonably priced. And then you look at something like Amazon here, right? Like Amazon should be another good exemplifier of what happens during a recession because, do you think in a full-blown recession, people would be spending more money on goods? No, you think they'd be pulling back, but these consumer goods and e-commerce is still growing at a really healthy clip. It shows that this innovation of e-commerce hasn't fully baked into the market, even in the worst of environments, that this thing is still able to grow at double-digit paces. I mean, it grew 12%, right? On these like the last earnings have been doing pretty exceptional. And you can see this revenue growth continues. I mean, again, we're not going back to the last decade where it was growing at 20 to 30 to 40, 50% clips. The question is, do you think we can get back here? Because if the market starts to nominalize and they do decide to cut rates, are people going to be willing to spend more money on products and goods? Like I said, if we don't go back to this kind of market, yes, these stocks should suppress a bit, but they shouldn't go back to some crazy lows. Like we shouldn't lose, a crazy huge amount of value in a stock like this. I just don't see it. It's not the dot-com era, right? We're still in a very reasonable position. Now, that means stocks could be fairly valued here if the growth persists at only a 10% clip. But again, this isn't like, I don't think this should be a new normal. Now, these are kind of like your more valued companies. These are companies that I think in this market environment are fairly valued. I think the market's done a good job justifying where they sit today. Now, if they cut rates and the market does return to a 20% growth rate on these mega cap giants, which could be hard to believe, but hey, if it does happen, like NVIDIA has been able to do, then these stocks will likely go up in value and they will return to an all-time high quicker than people will expect. Where the bubble did exist in this market environment that we just went through was in your crypto, your highly speculative, your companies that people just went bananas about. And in Canada, Shopify was a good example of this. Your cryptocurrencies were a good example. Your Pokemon cards. I mean, I don't think that the brunt of the stock market actually was crazy overvalued. I really just think it was the speculative growth markets where people were making money hand over fist and it just got really bubbly really quick. And Shopify was a great example of this. I mean, this stock tanked 80%. And now it's starting to prove that, hey, now I'm probably trading more toward a favorable value. I always had a hard time wrapping my head around Shopify's value, but you can't, deny the fact that their revenue in one of the worst market environments is growing at 30%. I'm like, it's hard to wrap your head around the value of a growth company when they're still posting 30% growth rates. I mean, it's absolutely bananas. I don't know how to value Shopify. I don't know if it's expensive or undervalued here, but if it keeps growing at 30% and growing beyond the bottom of the market, that when it dropped down, the revenue hit about a 15% growth rate. like I said, it just looks like things are starting to nominalize, and interest rates leveling off. And as mentioned, I think the market bottoms when obviously interest rates level off, because then all this debt that people have to pay on starts to finally hit a bottom in the EPS. So I don't know. Like I said, I'm not saying buy Shopify. I just think it's a good example of the bubble bursting, and I think we're beyond the burst point now. And now is like, if you're looking for value in the market, obviously I'm cost averaging into some of these indexes we'll talk about, but I still think the favorable value is in individual dividend stocks. And I don't think dividend stocks are justified just because interest rates are higher. Yes, people are going to sell dividend stocks to buy a fixed asset like a GIC or a high interest savings account or a bond that's going to yield 5 to 6% rather than own a dividend stock that only yields, say, 4%. But what ended up happening is so many people decided that clearly that they sold out of all these companies that, yes, have been doing worse in this market environment because, yes, they've had to pay more on their debt. It has been eating at their earnings per share, but they're hitting record revenues. They're controlling a lot of this debt and they're managing it very well while still sustaining, and not only sustaining, but increasing their dividends. I mean, TELUS increased their dividend on this last earnings. So you're getting 6% right now on a stock that is likely going to recover to an immense level when they start cutting interest rates. And again, that is a bull thesis that you have to kind of come to on your own conclusion, because if you don't think they're going to cut interest rates, then don't buy these stocks, because yes, these stocks are going to continue to be hindered. I mean, TELUS posted that they paid $900 billion, which is up something like 90%, some stupid amount. I have to double check, some stupid amount on interest payments. That'll be over $1 billion by the end of this year that could have went to the bottom line, and it didn't. So if they start cutting rates because they're using it as a Band-Aid to fix the wound that's still fully healing, which could happen in the next 6 to 12 months is my prediction. And I think people are going to sniff it out long before they start to cut rates and the market will start to recover. But as soon as that happens, guess what? All of a sudden, bonds, GICs, they're not as valued anymore. And guess what? These companies like TELUS that are hitting record revenues that can't reflect it directly to the bottom line right now are going to start reflecting it to the bottom line as they keep growing, because interest rates have leveled off, and then they cut rates. They have the revenue growth plus the rate cut, and boom, you get a perfect storm of EPS growth, unlike what we're seeing in this current market environment, which makes me think, yes, there is a lot of discounted levels. It is not a normal circumstance for a lot of these dividend companies. And you just got to find the ones that are proving to sustain this market environment and pick them up, because you could see growth like we're seeing on these days where it pops 10% for God knows whatever reasons happening, right? And then we got other stocks in here too, like Canadian Natural Resources we talked about, which honestly, I wouldn't be buying this stock here. I talked about this already. Their revenue and EPS is falling off. I think this has become a really dividend favorite because they've increased it by like 20% year over year, and recently have just grown it at absurd levels, and yet again increased the dividend against declining EPS, declining revenue. And I think that's what keeps people buying Canadian Natural Resources. And I think their price to earnings multiple is getting a little bit less favorable than a company like TELUS or some of these other stocks, where I think their revenue growth is becoming more favorable against the current valuation of their stock. Because again, they do a lot of write-downs and stuff. Don't trust the PE. I think the price to earnings multiple is much lower on TELUS than Google is going to reflect it. So a lot of people have been saying, yeah, is no one concerned about how sustainable this fantastic run on this price has been? I'm worried it'll crash back down and stay flat for the next 5 years. Yeah, C&Q of all the Canadian dividend giants, probably my least favorite based on just the current metrics that I'm seeing. Anybody that looked at that earnings can't be like, why is the stock running? How is the stock going up against this backdrop of but again, maybe it's because of the natural gas future. I mean, they are the natural gas powerhouse of Canada, basically. They have the largest natural gas reserve. So I think there's some speculation built into it perhaps as well. But then you got companies like Enbridge, right, which I think are more favorable here because their revenue growth is still very reasonable. They're doing quite well in this market environment, especially this a little bit more of a suppressed oil market. They've traded down a massive percentage, and the yield is getting back up there. And I don't think they increased the dividend on the last one, but man, Enbridge is, I still think, reasonable here. They're trying to wait for that acquisition to close on their natural gas company in the U.S. that I think makes them the largest natural gas powerhouse in the Western world, just by like distribution. But nonetheless, so this guy's saying they can't drop their dividend. Everyone would pull out and they would be done. Yeah, Enbridge, I think, is heavily reliant as a dividend company. And I think that, they kind of recognize themselves as that. But I think where some other value lies is in things like Bank of Nova Scotia. Some of these Canadian banks, which I've relentlessly said are buying opportunities of a lifetime. And this is a whole different metric against the interest rate environment, because if interest rates stay high, There's some contemplation on about mortgage renewals. And I think the only real black swan event that could still potentially take place, but I don't believe it's going to, is an actual collapse in real estate prices. We are seeing a softening in real estate prices, but because the supply and demand is still so messed up, it's causing people to sell homes but still have room to like other people to come in and buy them, and people are buying them, just not at the same volume levels that we've seen in the past, but it's being made up by the lack of demand and volume that's out there. So I'm really concerned that if a lot of renewals come up in the next year and interest rates don't start coming down, there could be some pain in the real estate market along with these banks, because these banks need to prove that people want to pay these mortgages, and they might continue to, because job market is pretty strong, but that's like the biggest hindrance against the banks. And honestly, I think, what is it like, it's not a huge percentage, but I think by 2025, 30% or 40% of all mortgages will come due. I got to double check those statistics. Don't quote me on that. But honestly, if we can get through the interest rate cycle before like 50% of these come into renewal, it'll be neat to see if the delinquency rating goes up beyond the pandemic, but we're not there yet. The pandemic was a much worse time for the real estate market than right now, statistically, based on the data that exists. But honestly, how much of that could have been priced in? Because these stocks have been wrecked. They have gone through a crash. They've been decimated. We're back into pandemic-like lows. Bank of Nova Scotia's dropped 40%. I mean, losing like half its value there, almost at the bottom. And every time it's done this in its history, it's been like one of a handful of times you could have bought it. 2008, it looks like we saw a pretty big drop here back in, and it wasn't even that big of a drop, maybe 20% in 2011. Another really big drop was during 2014. The stock dropped about 20. Like, this is statistically probably one of the worst drops outside of the pandemic in Bank of Nova Scotia's history. I mean, the pandemic, it wiped out 25% in a day, and from peak to trough, that was about 40%. So if you went back to 2017, so realistically, this is a once in like a 5-year, literally once in probably the last, since 1990s. All right. Since the 1990s, Bank of Nova Scotia has dropped this much over a 6 or 12 month period, realistically. Right. I mean, I don't know if there was ever a true shining light of a buying opportunity if we're looking at past historical data. I'm just saying, but we're going to read through some of your comments in a moment here. And then what we're going to do is we're going to get into my stock portfolio and show you guys what I've been buying, and where I sit as it currently stands in the market. Am I up or am I down? But kept BNS for a few years and super happy with the dips to grab a few more. Love their dividend. Yeah, they're not, again, the best performing bank, but the metrics, I can't get over them. And I still think they're pretty reasonable here. But let's read into some of the comments. A lot of you have been going bananas here. And then we're going to get into my own stock portfolio. Yeah, Enbridge is amazing. I've never owned, have I ever owned it on a personal level? I don't think so, mainly just through ETFs. Let's see. There's so many comments. You guys have started to rage down here. Let's see if we can get into it. Yeah, we're going to get into some Ryokan. Ryokan jumped up, I think, pretty reasonably there. So cheap ones are fake or stolen. Cheaper ones are made in Japan. What are you guys talking about here? My goodness. How much are Telecasters? Loaded up on Ryokan and VDY. I talked about O Realty Income. I think O Realty was a good buying opportunity there as well. There's a Ryokan troll on Yahoo boards. Whenever he shows up, it marks a local bottom. Ryokan is probably one of the better Canadian REITs if you're just looking for cash flow, along with Canadian Apartment Properties. Probably what's the industrial REIT that I really like? Not Dream, but the other one. Granite Real Estate's pretty awesome. Could have bought Shop. Dang, you still can buy Shopify. If it keeps growing at a 30 or 40% pace, it's still a buying opportunity, I think. Any company that can grow over 30%, like, I mean, go look at something like Palantir. Like Palantir, everybody like gloats about, and it can't even grow at the same pace Shopify is right now. And if you run the metrics on like the underlying asset bases, like you tell me on a comparable basis, what stock's a better buying opportunity? And I'd argue that Shopify is probably better than Palantir. I'll probably buy more CIBC. Speaking of increasing dividends, during the conference call for Ryokan, one of the analysts asked if Ryokan would be raising the distribution next quarter, and the CEO all but said yes. So yeah, I'll take a look deeper into Ryokan. I don't think, have they posted the earnings? I have to double check. I don't know if they posted yet, but if they did, I'll do a video on it. Every time I see pics of the well, I want to buy Ryokan. You guys in Ryokan, man, I didn't realize there was such a fan base for this. Isn't real estate crashing? Many Canadian mortgages coming to refinance, way more pain ahead this week. Like I said, I don't know. I don't know if real estate's going to crash. I have a hard time believing it will. Maybe in specific pockets. Toronto's still maintaining itself. Toronto's not crashing. It's softening, but it's not crashing. Durham region, some of the more like cottage country areas crashed. They crashed within like 2 quarters. I mean, there was like a 40% correction, like overnight almost in some of the pocketed areas, but Toronto's not crashing. Not yet anyways. Are you smarter than Warren Buffett, who says that the average person should just invest in the S&P 500 index? You think you're so much smarter than everyone else. Whoa, where is this coming from? At Patrick. What's Patrick saying? Every time I see pics of the, I'm going to have to double check this. Looks like you guys are getting heated down there. Most homes have no mortgages. I don't know if that's true. I think 30%, 20 or 30% of homes that exist in Canada are paid for. So there is some cushioning against crash as well from that aspect. And of that, not everyone bought in the last 3 years. Looks like you guys are getting heated, man. I don't know if I can keep up with the drama. Maybe I'll get into my portfolio just so you guys don't get bored of me rambling about these comments, and then I can come back and see what you guys are arguing about. The last 10 years, I'm outperforming the SPY by over double. For those who can't do that index in life, live your life. For those who can, indexes are useless. So as somebody who's like dramatically outperformed the S&P 500 by taking on a lot more speculation in the market, I think it is very hard to admit that you knew something that nobody else did. I think, like I said, so I had a humbling reality check because I'm like a numbers-based guy. And like for the last 8 years of my investing career, like I hit home run. Like they say when you collect a unicorn, like I think Charlie Munger said, I've only ever caught in like one stock, like BDY. Because like he picked that EV stock in China and he made like 500,000% return. He caught a unicorn. And he says that's a once in a lifetime event. I am somebody that like out of pure luck, and I'm not saying like I'm a genius by any metric, but I caught unicorn after unicorn after unicorn. And I'd like to say it's because I'm a genius, but I think I just got lucky picking up certain trends within a market environment that was blessed to be more speculative than it has been at any time, probably for the last, outside of the dot-com bubble, let's say, because I got Canopy Growth Corp, the best performing like MJ stock at the time. I mean, MindMed, we made 500 to 1,000% gains on. Tesla, just before the massive run up, I was able to capture. Apple, I walked away with over 500% gain on. Like I was able to pick up unicorns in individual stocks when everyone's like, oh, the market's too bubbly. It's all this, it's all that. And I was pretty ignorant to the fact of like what happens when things like this happen, right? Because when the market turns and you are not very careful about what you're doing, it takes 2 or 3 really bad stock positions that you have over leveraged in to wipe everything that you've worked for the last decade out. And look at Jeremy, like financial education. I think he showed some of his stock returns and he's still like outperforming the S&P, but because of like the terrible decisions he made, he wiped out like so much god awful amount of gains that like he was 1 or 2 more stocks away. If it wasn't for Tesla, that guy would have literally been the prime example of why picking stocks is so damn hard, because you can do good for so long. And if you are not utterly careful, you're just going to wipe yourself out, right? So you need to be just diligent and really make sure you understand what you're doing. Because like the only thing that saved my ass was in 2022, I said, F this, I'm horrified. I can't predict what's going to happen anymore. 20% gains are going away. You know, the revenue growth is going to fall off and I don't know who comes out of this alive. So I sold everything. I sold all my individual stocks and I went just purely into index funds because I'm going to let the indexes figure out who's going to be the best. It's a mechanical, you know, it's just a mathematical system of market cap weightings. Whoever's the best market cap stays on the index and I'll get the better of the performance of the half. So you just got to be super careful, man, in a market like this, and try not to get too cocky when you've been doing very well. Because trust me, it doesn't take a lot to humble you in a market environment like this. Just like I said, I'm not. You might do well, you might be a great stock picker, but I know I'm not in a market like this, and I'm just trying to avoid it as much as possible. Because again, I used all that money to also help buy a piece of real estate in the highest interest rate environment, one of the worst market environments ever. And instead of gambling and speculating on individual stocks, I've got a comfortable, affordable place to live because of those decisions, right? And I could have just as easily left it in the market, not bought a house. I could have rented. The market went down, and my rental prices would have been so absurd right now that I would have been in a worse position. I had a lot of people read me out over the last 6 months or the last year and a half, really, about selling the stocks, you know, buying real estate. God, like everyone's been against me on my financial goals here, and they've worked out pretty favorably. So I'm blessed. But hopefully, again, you guys just stay diligent, stay humbled, because trust me, it doesn't take a lot to humble you in this market. But as it stands today, I did invest $10,000. Yes, I finally bought back some VDY just to over leverage into some of the Canadian banks, some of these wonderful Canadian dividend stocks, because, hey, I'd love to buy all of them. And it's easier just to buy all of them in VDY for now. I don't want to buy individual stocks. And I am going to buy individual stocks. I'm just not buying them now because I have to transfer them to my tax-free savings account. And I don't know if the market's going to go higher or lower here. And I'll show you what I paid for it. But my concern is if I just start buying a lot of individual stocks, I'm going to have to sell them in 2 months and then move them to another account. And it's just going to be a headache. And I pay $10 commissions, which some of you lose your minds over. But yes, my bank charged me an arm and a leg for commissions. So I'm just doing this steadily. Okay. Very steadily. I have a decent chunk of cash still. I'm sitting on about $20,000. I've got 162,000 invested. And a lot of it's in the S&P right now. And because the S&P jumped up pretty dramatically, we saw some nice gains. So in this terrible market environment, I am still able to pull out about $2,500 in gains. Keep in mind, I did sell VDY for a $500 loss when I did sell it to move it to the S&P 500. So I may be only up like $2,000 in the retrospect of selling and not being able to actualize those losses on this chart. But nonetheless, we are very inchingly close to my goal of getting back over $200,000. That is primarily my goal into early next year. Right now, I'm sitting on about 160, 80, 90, 100, 192,000, give or take. So if we can get a few more paychecks, a few more good rallies in the market, I can get back to my goal. And from there, what I'm going to do is I'm looking at primarily just rebuilding my TFSA, and I'm going to show you again the individual positions where they sit right now. But I really want to build VDY back up and start buying some. If these stocks stay suppressed, if Bank of Nova Scotia, TELUS, these companies that I desperately love stay suppressed into the end of the year, I will upperweight them a bit to kind of equal weight VDY because they're lower weighted. I'm not going to buy Royal Bank or TD because they're so leveraged in VDY already. I just want to upperweight some of those lower weightings. And I think TELUS is a good buy here. Obviously, as I've been ranting about it pretty religiously, I obviously like Bank of Nova Scotia here still. So I'd upperweight those a bit. But we'll see. That depends on if the market stays in a position like it is now, because the market rallies and these stocks jump up 15 or 20% over the next 2 months, then yeah, I'm probably not going to buy them. And I'll just keep cost averaging into VDY. So it's pretty dependent on what the market does here. So we'll see what happens. But nonetheless, this is where my portfolio currently sits, and this is excluding a lot. I've decided that everyone keeps asking me, like, why don't you buy tech stocks? Why aren't you buying this? Why aren't you buying that? I still want to buy Google, just like I still want to buy Tesla at the right price. If the stars align, yes, I'll probably start buying them, but it'll be within my tax-free savings account or maybe my corporation, probably my TFSA, however. But still, the stars have to align where I get to next year, the markets are still in a good buying position for certain companies that I like. And then I can start cost averaging into them, hopefully starting at reasonable prices. But what's stopping me right now is my fiance, and again, I'm not going to really be talking about this much more moving forward, is that like I'm kind of pairing our portfolios off each other because she owns a lot of tech companies already. She's been doing very well with those tech companies like Meta, et cetera. So Meta's probably the largest position between both our portfolios, but I don't see the point in me putting it in this. And I also don't see the point in me just kind of sharing her portfolio and her percentages, right? So what I want to do is start showing you the build back of my portfolio as I move forward after this real estate purchase. So that's going to be primarily the focus moving forward, because I don't want to talk about her portfolio, but so many of you ask me why I have it built this way. And again, it's comparing it off, the fact that we just purchased big real estate, huge asset value in this property now, which is dumb. I don't really consider it an asset to an investment, other than it's just lowering my cost of living because it's not producing anything. So it's not really an investment, but hey, at least there's equity and it's going down in my cost of living isn't going up with inflation. So that's a bonus. But again, it's just kind of playing these comparables between like a bunch of, just diversity and aspects of everything considered. So everything considered, that's why my portfolio looks the way it looks. And taking a look at the positions themselves here, if that made any sense at all, VDY is what I purchased. I think it was Friday. I'm not up huge on it. I just wanted to get into it. I actually got pretty lucky because from where I sold it, I think I sold it around $41 when I sold it out of my corporate account. And then I got into the FOMO like everybody else, where I'm kind of miserable that the market's rallying aggressively. And I just don't want to get into a position where FOMO kicks in and the market starts jumping up 15 or 20%, because I still got an extra 10 grand I'm going to invest within my emergency fund that I show you in this account. That 20,000 doesn't actually accumulate the entirety of my emergency fund, because I have a joint account where I leave a very healthy amount of cash to cover our living expenses for like 6 months. My fiance's got her own emergency fund, so I'm probably going to keep 10,000 within my personal accounts. I'm going to take an extra 10,000. I have paychecks still coming in. I'm going to be flooding a ton of money into the markets literally January 1st, but I figured I would take half of that right now of the 20 that I want to invest, and I would just dump 10,000 of it in right now. Because again, I just don't trust the markets. And I know when these rallies happen and they're this aggressive, that they tend to persist to continue on for a lot longer. If I'm lucky, it'll start coming back down. maybe I take a capital loss when I move this. I don't know, but I'm just a psychological nut. And, sometimes when things, just happen, I just kind of make a decision and go with it. It's what I tend to do. I don't know if it's a good or bad idea, but we'll find out. So that's the position that I made there. In the corporate account, my S&P 500, my ride or die ETF is doing great. I have a goal and I want to get over 100,000 invested in VD or the VOO S&P 500. So I'm going to be divvying up my TFSA between VOO and the Canadian market still. But I really want to get this to a Canadian value, because right now the Canadian converted value, I think, is about 80. What did I say it was there? The Canadian converted value is about, 88,000. So I got to get about another 12,000 Canadian dollars in the S&P 500. I want to get it to 100K even. And then I'll probably pull back the reins on it a little bit and start aggressively buying some. I'll probably start looking at more individual stocks on that end of it when it comes to the US markets, and probably keep buying SCHD, which is in my RSP right now. But VDY, I really want to start paying attention to a lot. So I'm just going to try and bring my focus back to it. But for now, I'm very happy because I'm up 5.6%. I'm up on the Canadian dollar value still. So this has been a good cost average position for me. And I've been just progressively, I haven't been flip-flopping on that one. And then we got SCHD, which I'm down $2,000 on. But again, I've been reinvesting the dividends and actually rerounding this conversation off to the dividend percentage, because again, my end goal is going to take time, but I want 100,000 in SCHD, 100,000 in VOO. I'd like to inevitably get 100,000 in VDY. That's going to take a lot longer. I think I can start with one position being VOO to get to 100K. It just fills my soul with excitement to see that six-figure position in something like the S&P. But taking a look at the dividend income, which again, I'd like to say is my focus, but obviously as time's gone on, I've realized that dividends aren't the end all be all. But in a market like this where dividend stocks are cheaper, I would prefer to be buying them over anything else. And as we can see, since I did the real estate purchase, I bought mostly index funds. My dividend income now only sits at $4,353 or 2.73%. And so far, year to date, I've made about $7,111 in dividends versus this time last year where I almost made $12,000 or $8,000 a month. But again, this is the real estate purchase and the stock sell-off was somewhere more toward March, April, May timeframe. So there's been a slow deterioration in the dividend income. So I need to build this back. But I'm going to be building it mostly back through these index funds because that way it's passive. I'm not as worried about it. And we'll sprinkle on a little fairy dust with maybe some BNS and some of these other stocks. But let me just read through a few Q&As here real quick, and then we'll come back to the comments section. But I've been watching many of your videos on my road trip from Toronto to Vancouver. I really appreciate your content and its insightfulness. Because of you, I became very bullish on the Canadian banks and recently enjoyed the huge run-up. I am grateful and will consider joining your private member group. Thanks so much. You can always come back here for free. You don't got to join the Patreon member group. We do just chat in my chat group fairly frequently about all kinds of random investment stuff. TFSA limit will be $7,000 in the new year. Yes, that kind of annoys me a little bit because I have to rebuild the account up, and my contribution room is like 168,000 or whatever it was when I drew all those wonderful gains out. So it's going to be very hard for me to rebuild my accounts back when every year they're topping it up an extra $7,000. But hey, that's still wonderful news, baby. Let's go. Went on a shopping spree during the dip sale. Glad I did. Congratulations on picking up some value dips, like I've been saying in my last stream. Be buying, baby. Yeah, 7K is wonderful. Who do you think is paying for all the gold shilling commercials on YouTube and TV these days? Good question. My biggest problem with gold is that it is not finite. Robert Kiyosaki says gold is God's money and crypto is the people's money. And like paper money is just bullshit and fugazi and all that stuff. But when it comes to gold specifically, I hate the idea that it is anything other than one of the most manipulated assets out there. I don't care what you think about regular currency. I think precious metals are just a highly manipulated asset because we now know that they are not some finite thing. The amount of gold discoveries that have happened in the last 5 years alone has been insane. I mean, I think India discovered I think it was India, wasn't it? They discovered like a gold reserve that would it was over $1 trillion in gold value. You can't tell me that if some government entity or if every mining company under the sun said, hey, we want to overflood the market with gold, they can't just do that tomorrow. Every commodity is supply and demand metric, right? So I own gold. I've talked about this before, little bits, like I own cryptocurrency, little bits. I don't show those in my portfolio because I don't like talking about speculative investments, and anything that I think is speculative, I don't count toward my retirement. So when I'm looking at my long-term retirement, I'm only going to show you what I'm actually looking at. I'm not looking at gold. I'm not looking at crypto. I'm not looking at my small cap investments. I even have private placements. I don't care about any of that. That to me is just gambling, right? Because there's no way to understand the physical value, because it's all based off supply and demand right now. Anything that is a pure supply demand metric, I don't trust as a true investment, and gold falls into that basket, right? I know a lot of people might detest that, but gold, I just can't get over it. There's more discoveries going on every day, and there's so much asset value out there. Is it just being manipulated by paper? I mean, gold isn't going up like it should be because there's too much of it on the markets. And honestly, over time, if crypto takes over, the millennials don't care as much about gold. Will the supply not, the demand for that supply not start to fall off? It's like diamonds. Like diamonds are the most manipulated market, and even diamonds now are starting to lose value because the cartels don't own the market anymore. The market is largely owned by people that are printing diamonds, lab-grown diamonds. Like they're taking over the market and screwing up the cartel supply and demand metrics. It's like diamonds aren't like that unique anymore. Like it's a weird market when it comes to precious metals. I would always own the miners over the physical metals, in my opinion. I think if you're into precious metals, buy the miners, because the real value eventually comes into play when they build asset values, or they start flipping the mines, or they actually start taking it. Like there's a lot of mines right now that I think are trading at really good values because of the cash flow they're producing. But I just don't trust like gold holding it on its own. Just there's no upside in my opinion. Want gold, go to the Costco. Yeah, I know they're buying that now too. Polyair will make my TFSA 10K. Look, I'm not a political guy, but if I had to make a bet, and I'm hoping I can bet on it, I will take some money if I can bet on the next Canadian election. I am so confident Polyev is going to get in, and I don't care for politics. I don't care for Trudeau. I don't care for Polyev. I hate politics. I can't stand it all around. It doesn't really seem to do much of a difference over the long run. So I would rather just bet on who I think is going to be the popular winner, and I think Polyev is going to win. I could be wrong, but I'm willing to bet on it at this point. People seem to love that guy. Sing, don't make us all laugh. That's funny. Future PM, Polyev, yeah. Let's go back up here and see what else we got. I have a problem with CIBC. A few of my friends work as project managers for banks on contracts. They've worked for all the banks, and they all say CIBC is the worst run of all the banks. Insider news. I don't know, man. I don't. It could absolutely be. I don't know. Why do you think it's paying? Oh yeah, we just talked about the gold. Buy, they've been raising every year since. Smart centers. Let's finish up with a few more comments. I own smart centers in RioCan, best of both worlds. So I was having this conversation with my mother. Maybe I'll just anecdotally add this in. My mom wanted to buy some of these stocks for her retirement. And honestly, if you own real estate, and I want to state this a lot, and just hopefully this resonates a bit. A lot of people that own real estate also like to buy REITs. And if the vast majority of your money is in your residential home and it's in a specific market, like the Canadian market, it's probably not smart to necessarily be buying considerably more real estate in the Canadian markets. I think you're better off buying something like Realty Income if you own real estate, because that's what stops me from wanting to buy RioCan. We have some exposure. My fiance still owns a bit of it, but honestly, it puts me on edge a bit because the Canadian real estate market does crash. Then our property value goes down, our real estate investment trust value go down, and you just get hit so hard from so many angles. Just to be a little bit of an anecdotal pickup there. Any other comments, questions? Quarries, our rental in Toronto's are just stupid. That's why we bought. If I could have rented for $2,200 a 2-bed 2-bath, like I could have back in 2018, 2019, I would have said F buying, I'm going to rent. But now all of a sudden, like it's going to cost you about $3,400, $3,500 to get a 2-bed 2-bath that is at least 1,000 square feet. I'd hope you can get more than 1,000, but I doubt it. So you're spending 40 grand a year, which is a lot of people's gross income. I mean, you have to make what? Damn near 60,000 a year to bring home 40,000, and that's all going toward rent. That's the market we live in Toronto, baby. So yeah, we obviously bought. It was just the more intelligent decision for us because we, like I said, I know a lot of people probably don't have the position to, but we're just fortunate to be able to have liquid funds to make it so our monthly costs, like I think our total cost to carry right now with everything like utilities, HOA, if I had to put a direct number on, I think it's around $2,300 a month. So we're saving well over $1,000 a month owning, and that's insurance, property taxes, all that stuff. So I hate real estate. I just hate it. Don't put all your eggs in one basket. Yes, I agree. But people don't realize what a basket, like some people think, they forget they own real estate, and they forget that's a huge, part of their portfolio that, again, I don't consider real estate an investment. But nonetheless, I'm going to ramble here, going on for too long, folks. I do appreciate all of you coming out, and I hope you're all doing very well. I will look further into RealCan and maybe add to my position. I will do that as well, sir. I think earnings are coming up either way, so I will do a RealCan video specifically. Rent control exists. Any building that was built before 2019, Rob Ford for that one. Yeah, my uncles live right downtown Toronto, and they're paying $1,800 a month for a very nice condo because they've been living in it since the literal 80s, I think 70s, 80s. They've been there for like 30 years, and they've never really got crazy rental increases. Plus, they know the guy that owns the building, and they're right on like Church and Wellesley area. They're in a really good area. But yeah, anyways, folks, yeah, I hope you guys are buying. That's the only thing I got to say here. If you're sitting in a position where you're younger, having real estate issues, whatever, all this stuff, there's the only thing I can recommend is do what we did. If you can get along with your parents, live with them. I just talked to the guy that manages the utility or the amenities in our building, shooting the shit with this 23-year-old, and he has the same mindset that I've been relentlessly talking about. Just go to the markets, baby, where there's so much value and demand that you can't help but make money. Live with friends, live with family, and if you got to go move to Alberta or move somewhere cheaper, hell, this guy is going to school. He wants to work on natural gas pipelines. A brilliant guy. I'm like, couldn't be any smarter at 23 because he says like there's so much demand for trades. And he says that one thing he's going to school for will give him 3 or 4 different trade certificates. And he's thinking about moving to Alberta, and he's living with his parents right now. And I'm like, good on you, man. Crush it. Kill it. If you're 23, that's what you basically got to do to get ahead. I mean, I was literally watching a video on TikTok where this guy said, look, you want to start a good job? Go become a seamstress. Go open up, where you get your clothes, cleaned up. Start a cleaners, a dry cleaners. And everyone's like, it's crazy that we become so diluted as millennials and younger people that we're like, I want to work for tech. Like we all want to work, like we all want to be YouTubers. We all want to work these very few jobs, and all these old jobs that are still like absolutely required, like literal dry cleaning, nobody wants to do. So dry cleaners right now are making 6 figures a year. I was watching a video of a guy that's making almost like $500,000 a year owning a couple dry cleaners. I don't think people can appreciate these boring ass jobs that you could go out with very little education and make a lot of money. I mean, there's still huge opportunity in the market for people that actually go where there's demand for opportunity. It's not exciting, but hey, you know what is exciting? You do a job that at least you can enjoy, find something that you enjoy learning, a trade. You could apply to your own property, add value to fix and flips. But hey, you go learn these trades and you could physically retire in 10 or 15 years. I think that's what people need to like come back down to, because that's what I did, man. I was like 10 years. If I can just bite my tongue for 10 years and put the prison sentence in where I live as frugally and as cheaply as possible, I can cut back for the next 10. And in 20 years, I should be able to retire. That's what we're still dreaming here, baby. I'm 8 years into this. 8 years. God, I got 2 more years of prison, and I'm already come out of prison. I came out too early. I've been spending more than I probably should have. And, we already bought a house and all this stuff. But I put 8 good years in, and it's given me huge opportunities. So just do it, guys. Just give yourself 8 or 10 years without Starbucks. I still don't drink Starbucks unless I got a coupon. But stay cool. Stay awesome, folks. And as always, I'll catch you in the next one. Peace.